Japan just did something that hasn't happened in 40 years, something that broke a $7.3 trillion market in 18 hours. And starting today, Friday, February 6th, 2026, the contagion is spreading to US markets, to European markets, to every retirement account and investment portfolio on the planet. $4 trillion. That's the conservative estimate of what's about to be liquidated. Not might be, will be. Because this isn't a Japanese problem. It's the trigger. The first domino in a sequence that's repeated itself every single time a major economy loses control of its debt markets. And once the sequence starts, it never stops. It only cascades, faster and more violently than anyone predicts. Here's what happened. January 20th, Japan's Prime Minister, Sanae Takaichi, called a snap election for February 8th, 2 days from now, and she promised voters something irresistible. Suspend the 8% consumption tax on food, increase government spending, more stimulus, more benefits. Sounds great, right? Except for one problem. Japan's national debt is 237% of GDP, highest in the developed world, by far. The United States is at 125%, and everyone thinks that's catastrophic. Japan is at 237%, and they just promised to cut taxes and increase spending with no funding source, which means more debt, more bonds, more borrowing. And bond markets said no, violently. January 21st, the bond market crashed. The 40-year Japanese government bond yield spiked 25 basis points in a single session. In the Japanese bond market, that's not volatility, that's an earthquake. Yields on that maturity normally move by fractions of a basis point per day. Sometimes it takes months to see a 10 basis point move. They moved 25 basis points in 6 hours. The 30-year yield jumped 30 basis points, hit 3.9%, highest on record. The 10-year went to 2.35%, highest since 1999, in one day, one session. The most violent repricing of sovereign debt since the UK's Liz Truss moment in 2022. And here's what nobody's saying out loud. This isn't contained to Japan. Japan holds over $1 trillion in US Treasury securities. They're the largest foreign holder of American debt. When Japanese yields spike, Japanese investors can earn more at home. Why buy US Treasuries at 4% when you can get Japanese government bonds at 4%? Same yield, no currency risk. So they sell US bonds. And when the largest foreign buyer becomes a seller, US yields spike too. 10-year Treasury yields jumped 6 basis points the day after Japan crashed. 30-year yields moved even more. That's contagion. That's the mechanism starting. But it gets worse, much worse. Because this isn't just about yields. It's about what yield spiking means for every asset priced off of them. Stocks, real estate, corporate bonds. Every financial asset in every market is priced relative to risk-free rates. When those rates explode higher, everything else reprices lower, violently. And the math says 4 trillion is the floor, not the ceiling. By the time the sequence completes, we're looking at 6 to 8 trillion in global asset liquidation, starting today. Now let me show you why this is inevitable, why this isn't just a bad week in Japanese bonds, why this is the beginning of a pattern that's played out 17 times in modern financial history. Because once you see the pattern, once you understand the mechanism, you'll know exactly what's coming next. And more importantly, you'll know how to position before the cascade accelerates. There's a sequence, 4 stages. Every time a developed economy with massive debt faces loss of bond market confidence, the sequence is identical. Stage 1 is the setup. This is where a government accumulates debt beyond sustainable levels, not just high debt, unsustainable debt, where interest payments start consuming meaningful portions of government revenue, where debt to GDP ratios enter territory that historically precedes crises. Japan spent 30 years building to this, 3 decades of deficit spending, stimulus packages that never worked, promises to retirees and voters that couldn't be funded through taxation, building and building until the debt was 237% of GDP. That's the setup. Creating a situation where the only way to service existing debt is to issue more debt. Stage 2 is the dependency. This is where the government becomes dependent on bond markets staying calm, dependent on yields staying low. Because if yields rise significantly, the interest cost explodes. Japan's national debt is roughly $13 trillion. At 1% interest rates, that's $130 billion in annual interest. Manageable. At 4%, $520 billion in annual interest. That's almost a quarter of Japan's entire government budget. Just interest, not principal, not programs. Interest. So governments in stage 2 do everything possible to keep yields suppressed. Central bank bond buying, yield curve control, financial repression, whatever it takes, and it works for years, sometimes decades. Yields stay artificially low, markets stay calm, everyone believes it's sustainable. Stage 3 is the break. This is where confidence shatters. Something triggers the market to question whether the debt is actually sustainable. Could be a political event, a policy announcement, a change in central bank strategy. Doesn't matter what specifically triggers it. What matters is the psychology shifts, from calm acceptance to questioning, from complacency to fear. And when confidence breaks in bond markets, the repricing is violent, fast, brutal. Because bonds are the deepest, most liquid markets in the world. When they move in size. Billions of dollars liquidated in hours. Yields spiking, prices collapsing. And once the break starts, it feeds on itself. Selling begets more selling. Rising yields beget more rising yields. A cascade. Stage 4 is the contagion. This is where the crisis that started in one country's bond market spreads globally. Because modern financial markets are connected, integrated, correlated. When Japanese yields spike, it affects U.S. Treasury markets. When U.S. markets get hit, it affects European markets. When developed market bonds all reprice higher, it affects emerging markets. Currencies crash, stocks collapse, credit spreads blow out. Everything reprices simultaneously. And wealth transfers, massively. From those holding assets denominated in the affected currencies to those holding hard assets. From those who didn't see it coming to those who did. Now let me show you this pattern in action. 3 times, 3 major economies, same sequence, same outcome. Then we'll apply it to what's happening in Japan right now. And you'll see exactly where we are and what comes next. United Kingdom, September 2022. Liz Truss became Prime Minister on September 6th. She had campaigned on tax cuts and deregulation, growth at any cost. Within 3 weeks, her Chancellor Kwasi Kwarteng announced the mini-budget. September 23rd, £45 billion in unfunded tax cuts, abolished the top rate of income tax, cut corporate taxes, cut stamp duty, all without identifying spending cuts or revenue sources to pay for it. The market reaction was immediate and brutal. Stage 1 had been building for years. Brexit uncertainty from 2016 onwards. COVID spending exploded the deficit. Government debt went from 85% of GDP to over 100%. Not catastrophic by itself, but trending wrong. Stage 2 was Bank of England quantitative easing. They'd bought £437 billion of government bonds, kept yields artificially low. Markets became dependent on that support. Then Truss triggered Stage 3 in spectacular fashion. September 26th, just 3 days after the mini-budget announcement, UK government bond yields exploded. The 30-year gilt yield spiked from 3.5% to 4.5%, 100 basis points in 3 days. Pension funds holding those bonds as collateral suddenly faced massive margin calls. They used a strategy called liability-driven investing, leveraged positions in long-dated bonds. When bond prices collapsed, their leverage turned toxic. They were forced to sell bonds to meet margin requirements. That selling pushed yields even higher, a doom loop. Classic Stage 3. By September 28th, pension funds were in crisis. They managed £3 trillion in assets. If they were forced to liquidate at distressed prices, the entire UK financial system faced systemic risk. The Bank of England had no choice. Emergency intervention. They announced unlimited purchases of long-dated bonds. Whatever it took to stop the spiral. Simultaneously, Truss was under political pressure. By October 14th, Kwarteng was fired. By October 20th, Truss announced her resignation. 44 days as Prime Minister, shortest tenure in history. But the damage was already done. Stage 4 had cascaded. Sterling crashed from 1.12 against the dollar to 1.03. Parity, a 20-year low. UK stocks, the FTSE 100, dropped 15% from September highs. Real damage to pension values. Mortgage rates spiked from 3% to over 6% in weeks. Housing transactions froze. Prices started falling. Wealth transferred. From bondholders who bought at low yields to those who bought the crash. From homeowners facing unaffordable remortgages to cash holders. From pension funds to predatory hedge funds who saw the crisis coming and positioned accordingly. The transfer was measured in hundreds of billions of pounds in 6 weeks, all because a government announced fiscal policies bond markets deemed unsustainable. Greece, 2010 to 2015. The sovereign debt crisis that nearly destroyed the euro. Stage 1 was a decade of deception. Greece joined the euro in 2001. Suddenly had access to German-level interest rates. Before the euro, Greek government bonds yielded 7 to 8% reflecting risk. After joining, yields dropped to 3 to 4%, same as Germany. Markets treated Greek debt like German debt. Fatal assumption. Greece borrowed massively, funded pensions they couldn't afford, hired government workers excessively, ran deficits every single year. Debt to GDP went from 103% in 2001 to 129% by 2009. All funded at artificially low rates. Stage 2 was complete dependency on bond market complacency. Greek government needed to roll over roughly 50 billion euros in maturing debt every year, plus fund annual deficits of 30 to 40 billion, 80 to 90 billion in annual borrowing. As long as markets stayed calm, as long as yields stayed low, this was manageable. Greek banks bought Greek government bonds. European banks bought them. Everyone assumed the euro provided implicit backstop. Then, in October 2009, newly elected Prime Minister George Papandreou revealed the truth. The budget deficit wasn't 6% of GDP, as previously reported. It was actually 12.7%. Double. They'd been lying about the numbers for years. Stage 3 detonated. December 2009 into 2010, Greek bond yields spiked from 5% to 12% in months. By April 2010, yields hit 21%. Markets were pricing in significant default probability. Greek government couldn't borrow at those rates, couldn't fund operations, couldn't pay pensions or salaries. May 2010, European Union and IMF had to provide a 110 billion euro bailout, but that didn't solve the problem. It bought time. By July 2011, yields were back at 25%. Another crisis. Another bailout required. 130 billion euros, still not enough. By March 2012, Greece was forced into the largest sovereign default in history. Private bondholders took a 75% haircut, 100 billion euros in losses. Stage 4 consumed Europe. Portuguese yields spiked from 4% to 16%. Ireland required an 85 billion euro bailout. Spain's borrowing costs hit 7%, the level considered unsustainable. Italian yields approached similar levels. The entire European banking system faced insolvency because banks held huge positions in peripheral European debt. Stock markets crashed continent-wide. Euro itself was questioned. Existential crisis. The European Central Bank was ultimately forced into unlimited bond buying. Mario Draghi's famous "whatever it takes" speech in July 2012. They bought sovereign bonds of Spain and Italy to cap yields, prevented full contagion. But the damage to Greece was permanent and catastrophic. Greek GDP fell 25% from 2008 to 2013. Not recession, depression. Unemployment hit 27%. Youth unemployment above 60%. Pensions cut 40 to 50%. An entire generation saw wealth destroyed. Property values crashed. Banks imposed capital controls. Couldn't withdraw more than 60 euros per day from ATMs. Meanwhile, German banks and hedge funds that had shorted Greek debt or bought Greek assets at bankruptcy prices made fortunes. Wealth transfer measured in hundreds of billions of euros, from Greek citizens to foreign creditors. All because bond markets lost confidence in fiscal sustainability. Once Stage 3 started, nothing could stop Stage 4. Japan. 1990 to 2003, the original debt crisis that set up today's situation. Stage 1 was the 80s bubble. Japanese real estate and stock markets went parabolic. The Nikkei hit 39,000. The grounds of the Imperial Palace in Tokyo were theoretically worth more than all of California. Debt fueled speculation everywhere. Then the bubble burst, 1990. Nikkei crashed 75% over 13 years. Real estate fell 60 to 80%. But the government didn't let the system cleanse. They intervened. Massive stimulus. Infrastructure spending, bailouts, all debt financed. Debt to GDP went from 50% in 1990 to over 150% by 2003. Stage 2 became permanent policy. Near zero interest rates for decades. Bank of Japan buying government bonds to keep yields suppressed. Yield curve control. Whatever it took to keep borrowing costs low. Because any meaningful rise in rates would bankrupt the government through interest costs. This worked for 20 years. Yields stayed near zero, but the debt kept growing. And growing. To today's 237% of GDP, Stage 3 is what just happened. January 20th, 2026. Bond market said no more. Yields exploded, confidence broke, and Stage 4 is starting today, right now. See the pattern? Setup. Dependency. Break. Contagion. UK, Greece. Japan in the 90s. Same sequence, different decade. Identical outcome, and it's happening again. In Japan, today. Except this time it's bigger. Much bigger. Because Japan isn't a peripheral European economy. Japan is the world's fourth largest economy, with 13 trillion in government debt, holding 1 trillion in US Treasuries, integrated into every global financial market. When Japan's bond market breaks, the contagion is global, immediate, unstoppable. Now let me walk you through exactly where we are in this sequence, using Japan today, so you see what just happened, what's happening right now, and what comes next. Stage 1. Setup. Japan's debt to GDP at 237%. Built over 3 decades. Everyone knew it was unsustainable mathematically, but as long as yields stayed low, it was manageable. 1% interest on $13 trillion of debt? Expensive, but payable. Check. Setup complete. Unsustainable debt load created. Stage 2, dependency. Bank of Japan implemented yield curve control, unlimited bond buying to keep 10-year yields below 0.25%. This lasted from 2016 to March 2024, 8 years of artificial suppression. Markets became dependent on the Bank of Japan being the buyer of first and last resort. Over 50% of all Japanese government bonds were owned by the Bank of Japan, not private investors, not pension funds, the central bank. When you're the central bank and you own half of your own government's debt, that's not a market. That's a control mechanism. Check. Dependency established. System requires artificial support to function. Stage 3, the break. This is where we are right now. The timeline matters. March 2024. Bank of Japan ended negative interest rates for the first time in 8 years. Started normalizing policy. Started reducing bond purchases. Markets got nervous but held. Then came January 20th, 2026. Prime Minister Takaichi calls snap election. Promises to suspend consumption tax on food. Promises more spending. No funding source identified. Bond market revolts. January 21st, 40-year yields spiked 25 basis points in one session. 30-year yields up 30 basis points. 10-year yields to 2.35%. Highest since 1999. But here's what's critical. This wasn't one bad day. January 22nd, another weak auction. 20-year bonds couldn't find buyers at any reasonable yield. More selling, more volatility. By January 28th, Treasury Secretary Scott Bessent is calling his Japanese counterpart, expressing concern. By February 3rd, just 3 days ago, another weak 10-year auction, yield of 2.25%, 40 basis points higher than the December auction, demand deteriorating, markets questioning sustainability. Stage 3 is active. Right now, today, check. Now here's where it gets terrifying. Stage 4, contagion. This is what's starting today. Right now as you're watching this. The mechanism is specific, detailed, inevitable. Japanese investors hold massive amounts of U.S. Treasuries, over $1 trillion. For years, they bought U.S. bonds because Japanese yields were zero or negative. U.S. Treasuries at 2 or 3% looked great. But now, Japanese government bonds yield 2.25% on 10-year, almost 4% on 40-year. Same or better yields than U.S. Treasuries in their home currency. No exchange rate risk. So what do? They sell U.S. bonds, buy Japanese bonds, repatriate capital. This is already happening. U.S. 30-year Treasury yields have climbed from 4.1% in early January to 4.35% today. Doesn't sound like much, 15 basis points. But on a $30 trillion Treasury market, that's hundreds of billions in lost value. And it's accelerating, because it's not just Japan. Other foreign holders see this, see the largest foreign holder of U.S. debt selling. And they question whether they want to hold U.S. Treasuries at current yields when the trajectory is higher. So they reduce positions. More selling, yields rise further. Feedback loop, just like Greece, just like UK. Stage 4, beginning. And equities? Stock markets are already feeling it. Higher bond yields mean higher discount rates for valuing stocks. The S&P 500 forward PE ratio is 22, historically elevated. At current earnings, fair value is probably 18. That's an 18% correction just to get normal valuations. But with yields spiking, with Treasury yields moving towards 5%, fair value is probably 16 PE. That's a 27% decline from current levels. On a $45 trillion U.S. equity market, that's over $12 trillion in nominal losses. Globally, including European and Asian equities, $4 trillion is the floor. $6 to $8 trillion is realistic. And the cascade hasn't even fully started yet. Credit markets are next. When risk-free rates spike, credit spreads widen. Corporate bonds reprice lower. Companies with heavy debt loads face refinancing crises. High-yield spreads are already widening, from 250 basis points in December to 300 basis points today. That's 50 basis points in 6 weeks. If this continues, if stage 4 fully unfolds, high-yield spreads could go to 600 or 800 basis points. Like 2020, like 2008, corporate bonds would crash, defaults would spike, credit contagion would hit banks, financial system stress, and currencies. The yen has already moved from 145 to the dollar in December to nearly 160 by late January. That's a 10% devaluation in 6 weeks. The Bank of Japan tried to stop it. The Federal Reserve New York conducted rate checks, signaling potential intervention. But intervention only works if the underlying problem is solved. Japan's fiscal situation isn't solved, it's getting worse. If the yen breaks 160 convincingly, next stop is 180, 200, currency crisis. And a crashing yen means Japanese investors repatriating capital sell even more foreign assets. More U.S. Treasuries dumped, more European bonds sold, more contagion. Real estate markets will reprice. In Japan, mortgage rates have already spiked. from 0.5% to over 1.5% in 18 months. Housing transactions are freezing, prices starting to fall. But also in the US, mortgage rates tied to 10-year Treasury yields. As those yields spike, mortgage rates follow. Already at 7%. If 10-year Treasuries go to 5%, mortgage rates go to 8%, housing market freezes. Prices fall 20 to 30% in major markets. Wealth effect reverses. Consumer spending falls, recession feedback loop. This is stage 4. This is what's starting today. And every historical example says, once stage 4 begins, it doesn't stop until a resolution is forced, either through massive central bank intervention that restores confidence, or through default, restructuring, and system reset. And the problem is, Japan's already tried intervention. The Bank of Japan has been intervening for 8 years. Yield curve control, unlimited bond buying. It stopped working. When the market loses confidence in a sovereign borrower, there's no amount of central bank intervention that can restore it permanently. The UK tried, worked for 2 weeks, then trust was gone. Greece tried, ended in default and bailout. Japan's trying now, and markets are calling the bluff. Now let me destroy the 3 most common objections. The 3 reasons people think this time is different. The 3 beliefs that will cost them dearly. Objection 1. Japan's debt is different because it's domestically held. Over 90% of Japanese government bonds are owned by Japanese entities. Bank of Japan, Japanese banks, Japanese pension funds, Japanese insurance companies. So the argument goes, Japan can't have a debt crisis because they owe the money to themselves. This is dangerously wrong. Domestically held debt doesn't change the mathematics. If yields rise from 1% to 4%, interest costs quadruple, regardless of who holds the bonds. And Japanese institutions aren't charity. They're profit-seeking or benefit-paying entities. If they can earn 4% on government bonds with rising fiscal risk, or earn similar yields elsewhere with less risk, they'll reduce JGB holdings, already happening. Japanese banks reduced JGB holdings by 8% in the last year. Insurance companies cutting exposure. Pension funds diversifying internationally. Domestic holders can trigger crisis just as easily as foreign holders. Objection 2. The Bank of Japan can just buy all the bonds. Unlimited balance sheet. They've done it before with yield curve control. They'll do it again. This time is different, except they already tried for 8 years, and it stopped working. Here's why. When a central bank buys its own government's debt, it's monetization, money printing, which causes inflation. Japan's inflation has been above the Bank of Japan's 2% target for 4 consecutive years, currently at 3.1%. If they restart unlimited bond buying, inflation accelerates. Yen crashes further. Imported inflation spikes because Japan imports 80% of its energy. Inflation hits 5, 6, 7%, at which point the cure is worse than the disease. Citizens revolt against inflation. Government forced to tighten. Either way, crisis. Objection 3. This is just political noise before an election. After February 8th, after the election, markets will calm down. Takaichi will clarify funding, or her opponents will win and reverse course. Everything goes back to normal. Wrong again. Elections don't solve structural debt problems. UK elected a new government after trusts. Debt problems remained. Greece had multiple elections during their crisis. Didn't matter. The mathematics don't care about politics. Japan's debt to GDP is 237%. That number doesn't change based on who wins Saturday's election. Takaichi wins, more stimulus, more spending, more debt. Her opponents win? They're promising similar policies, different packaging, same fiscal direction. Either outcome results in more bond issuance, more supply, which means yields stay elevated or go higher. The election doesn't solve anything. It confirms the problem is unsolvable politically. So what do you actually do? How do you position when you're watching a $4 trillion liquidation begin in real time? First principle, understand that this is not contained to Japan. The integration of global financial markets means contagion is automatic, mechanical. When the world's 4th largest economy's bond market crashes, when the largest foreign holder of US debt becomes a seller, when currency markets dislocate, everything reprices. Your retirement accounts, your investments, your assets denominated in currencies connected to the yen or dollar. Nothing is isolated. Second principle, rising yields are a tax on every asset class. Stocks reprice lower, bonds lose value. Real estate transactions freeze, credit spreads widen. Only cash and very short duration assets preserve value in this environment. Everything else loses. The magnitude depends on duration and leverage, but direction is universal, down. Third principle, contagion moves faster than you think. The UK's crisis was 2 weeks from announcement to intervention. Greece took months, but the acute phase was weeks. Japan's is happening in days. February 6th, today to February 8th election is 2 days. What happens Monday, February 9th when markets reopen after the election? What happens if yields are even higher? What happens if the cascade accelerates? You won't have time to react. Positions need to be taken now. Fourth principle, central banks have limited tools against sovereign debt crises. They can buy bonds, but that causes inflation and currency collapse. They can raise rates, but that makes debt service impossible and triggers recession. They can do nothing, but that means market-determined repricing. All options are bad, which means the crisis resolves through pain, either inflation pain or deflation pain or default pain. But pain is inevitable. So here's the specific playbook for today. Friday, February 6th, 2026, before the Japanese election Saturday, before Monday's market open, before stage 4 accelerates further. If you're holding long-duration bonds, anything over 5-year maturity, reduce exposure immediately. The risk-reward is terrible. Your earning may be 4%, but exposed to 20 to 30% downside if yields spike another 100 basis points. And they could. They probably will. Move to very short duration. Treasury bills under 1 year, money market funds, something that reprices daily so you're not locked into rates when yields are moving. If you're fully invested in equities at current valuations, reduce exposure significantly. I'm talking 30 to 40% reduction. Not because companies are bad, not because economies are collapsing tomorrow, but because financial conditions are tightening violently. When credit spreads widen, when Treasury yields spike, when the largest foreign buyer of U.S. debt becomes a seller, equity valuations compress fast. Better to take some chips off the table now. Wait for the repricing. Buy back cheaper in 3 to 6 months. If you're fully invested in equities at current valuations, reduce exposure significantly. I'm talking 30 to 40% reduction. Not because companies are bad, not because economies are collapsing tomorrow, but because financial conditions are tightening violently. When credit spreads widen, when Treasury yields spike, when the largest foreign buyer of U.S. debt becomes a seller, equity valuations compress fast. Better to take some chips off the table now. Wait for the repricing. Buy back cheaper in 3 to 6 months. If you're in international funds, especially emerging markets, reduce dramatically. Emerging market currencies crash when developed market rates spike. Capital flees to perceived safety, dollars. Even with U.S. problems, the dollar strengthens relative to emerging currencies when risk-off accelerates. Emerging market equities down 20 to 30%. Emerging debt down similar amounts. Get out before Monday. If you're in real estate or REITs, understand values are about to reprice significantly lower. Higher mortgage rates mean lower home prices. Simple mathematics. And REITs are particularly vulnerable. They're leveraged. Higher rates mean higher debt service costs and lower asset values. Double squeeze. REIT prices can drop 40 to 50% in these conditions. They did in 2020. They did in 2008. Happening again. And here's the counterintuitive move. Consider exposure to very short-term U.S. Treasuries or Treasury bills despite the contagion risk. Because when risk-off accelerates globally, even if U.S. debt is part of the problem, Treasuries benefit from safe haven flows. Paradoxical, but historical. During acute stress, money flows to dollars and short-term U.S. debt, even when U.S. fundamentals are weak. 6-month T-bills currently yielding 4.5% with minimal duration risk. Better than being fully invested in assets losing 10 to 20%. Physical gold allocation makes sense. Not because gold is going to the moon necessarily, but because it's non-correlated. When bond markets crash, when equity markets reprice, when currencies dislocate, gold holds value. It's already at $5,000. Hit a record high during the Japan crisis in late January. Could go higher. But even if it just preserves value while other assets lose 20%, that's a win. Now let me tell you what's coming next. The timeline for stage 4 progression, because if history repeats, and it always does, the sequence is predictable. Saturday, February 8th, Japanese election. Either Takaichi's party gains seats and pursues expansionary fiscal policy, or opponents win and pursue similar policies with different branding. Either way, markets react negatively Monday because the fiscal trajectory doesn't change. Yields stay elevated or go higher. Monday, February 9th through Friday, February 13th. First full trading week after election results. This is critical. If Japanese yields stay above 2% on 10-year and 4% on 40-year, the crisis is confirmed. Not temporary election noise. Structural break. Foreign investors accelerate selling of Japanese assets. Yen continues weakening. Bank of Japan faces intervention decision. But intervention probably fails unless accompanied by fiscal clarity, which isn't coming. Mid to late February, contagion accelerates. U.S. Treasury yields spike towards 5% on 10-year. 30-year approaches 5%. European bond yields follow higher. German bunds rise. French and Italian spreads widen. Global equity markets reprice. Corrections of 10 to 15% in U.S. worse in Asia and Europe. Credit spreads widen significantly, high yield approaches distressed levels. Banks face questions about bond portfolio losses. Financial system stress visible. March 2026. Either intervention succeeds in stabilizing. Central banks coordinate. Massive liquidity injections. Emergency measures. Markets stabilize but at lower levels. 10 to 20% losses locked in. Or intervention fails. Crisis accelerates. Yields keep rising. Equities keep falling. Credit markets seize. Banks need support. Sovereign debt questions spread to other high-debt countries. Italy, France, UK, full contagion. At which point we're looking at 30 to 40% equity declines globally. 4 trillion becomes 6 trillion, becomes 8 trillion. Becomes a full systemic event requiring unprecedented intervention. And here's what nobody wants to say out loud. The intervention that stops this crisis, if it comes, will require coordination between Federal Reserve, Bank of Japan, European Central Bank, and probably others. It'll require simultaneous balance sheet expansion, synchronized rate cuts maybe, emergency swap lines, currency interventions, the whole toolkit deployed at once. Because this isn't just a Japan problem. It's a global debt problem, where Japan is just the first domino. And stopping one domino from falling doesn't matter if 10 more are lined up behind it. February 6th, 2026, $4 trillion in global asset value is already gone, or about to be liquidated. That's conservative. Based on equity market repricing from elevated valuations, based on bond market losses from yield spikes, based on currency devaluations, based on real estate adjustments to higher rates. If stage 4 fully unfolds, if contagion accelerates as history suggests it will, 6 to 8 trillion is realistic, from equity markets dropping 15 to 25% globally. Credit markets repricing as spreads widen 200 to 300 basis points. Currency devaluations cascading through emerging markets. Real estate falling 10 to 20% as financing costs spike. It all compounds. It all feeds on itself. And the decisions you make today, Friday, February 6th, 2026, before the Japanese election tomorrow, before Monday's market open, before the cascade potentially accelerates, those decisions determine whether you're on the right side or wrong side of this transfer. You have hours. Not days, not weeks, hours. Because by Monday morning, if election results confirm fiscal expansion, regardless of who wins, if yields spike further, if contagion accelerates, repositioning becomes harder, more expensive, maybe impossible if liquidity dries up. This is not fear-mongering. This is pattern recognition backed by verified data. Japan's debt is 237% of GDP. Fact. Bond yields spiked 25 basis points in one session on January 21st. Fact. Treasury Secretary Bessent called his Japanese counterpart expressing concern. Fact. Fed New York conducted rate checks on the yen. Fact. Japan holds over $1 trillion in U.S. Treasuries. Fact. Every one of these facts is documented, verifiable. And together they paint a picture of stage 3 transitioning to stage 4. Just like UK. Just like Greece. Same pattern, different country, identical mechanism. Because, make no mistake, this is a wealth transfer. From those who stay fully invested in long-duration assets at peak valuations to those who move to safety. From those who believe central banks will solve everything to those who understand the mathematics. From those who think this time is different to those who recognize the pattern and position accordingly. The Japanese bond market crash of January 2026 will be remembered as the trigger. The moment when the largest debt burden in the developed world met bond market rejection. When artificial suppression broke. When stage 3 became stage 4. And when a $4 trillion liquidation became inevitable. You're watching history. The question is whether you're positioned correctly for what comes next. If this opened your eyes to what's actually happening, to the pattern, to the mechanism, to why this is just beginning, not ending, then you need to see what I'm releasing next. Because the next video breaks down exactly how this contagion spreads to the U.S. Treasury market, why 10-year yields are heading to 5%, why that triggers a 20 to 30% equity correction, and most importantly, the specific trades, the specific positions, the specific moves that protect you and potentially profit from what's coming. Subscribe. Hit notifications. This is the most important financial event of the decade, and it's happening right now.